this session, just a kind reminder, it will be in Chinese. So for those that need the translation assistance, you can put on the headset. For those that don't have the headset, it's actually at the back of the room. Please go and grab one. We'll give you guys 10 seconds to mic up. All right, let's start.
Well, ladies and gentlemen, good morning. In this session, we'll cover a topic that is to invest in the best strategy. Now we're on the rate hike, and we are also at the peak of US-China trade talks. China's stock market is also on its spike. In these circumstances, many investors are still wondering what is the best investment strategy, what is the best portfolio. Many people are watching Chinese bond market. Should we invest in bond or stock? Now, the convertible bond market is also very popular. Subscriptions are very hot, and people want to make money from this round of investment in bond. Let me give you one question. If you have $1 million, how would you invest this year? Before I throw the question to the audience, let's just hear what these three speakers will say. Let's start from Mr. Wang. Mr. Wang is the president of Chongyang Investment. Chongyang Investment is one of the biggest hedge funds in China. It's a $1 million question, literally. So I would just focus on things I'm familiar with. We focus on A-share and H-share market, those China-related stocks. We believe to invest in the stock market in China, we should have good opportunities this year. There are a few reasons, very simple. Last year, in A-share and H-share market, you saw the worst performance among the global markets. However, this year, these two markets returned with best performance. So we cannot explain that with some simple reasons. There must be some fundamental changes. So what are the fundamental changes? And will their impact continue to play the role? This is the question we have to answer. In my mind, we have to say yes to both of the questions. There are two important reasons. One is domestic reason. Last year, deleveraging efforts in China were playing an important role. Second, we have policy measures to control the capital market, and these were the two main reasons behind the underperformance of A-share market last year. The second type of reasons are related to US-China trade war and also the rate hike. With the hindsight, these reasons have shown some fundamental changes, some changes of direction. China has changed its policy of deleveraging. Actually, this started from the second half of last year. They started to cut triple R, and there would be possible room for further cut in interest rate. China is taking that seriously from the government perspective, but the external reasons are even more important. For example, yesterday, the Fed's meeting was making an important decision about rate hike. What I'd like to emphasize is that China and US are making positive progress in trade talks, and the impact will be very far-reaching. I believe the impact will be on the market-oriented reform in the financial industry in China, and it will squeeze the risk premium in both A-share and H-share market in the long term. If we take into account these reasons, they will be giving us a positive perspective to both markets. A-share market has recorded very good rally, but H-share is a bit lagging behind. But if you ask me the $1 million question, I think we should be very proactive in grabbing the opportunities in both A-share and H-share market, eyeing on the good returns and better than what we had last year. Thank you, Mr. Wang. Thank you for the positive note on H-share and A-share market. Mr. Zhang, please. Before I was asked the question, I think this question is both complex and simple. We focus on family offices, multi-asset portfolio. So let me ask you, what's your risk appetite? What's your liquidity requirement? So with that, the answer will speak for itself. However, that also relates to how you see the future. In every asset type, I think the most important thing is to do a bottom-up job well. You look for the fundamental underlying assets, you look for the entrepreneurs, you look for the high-quality companies and hold them for long term. It's not about 1 year, it's not beating the market in the short term. For us, I think we are very long on the early stage venture capitals, especially high-tech, healthcare. There are some innovation opportunities. I think companies in this pool have very high quality. I'm talking about their entrepreneurs. And we have the application of AI technology, which is maturing in these years, and they are changing the market. They are improving our efficiency. They are creating some premium value, and we think this is something for sure. Looking back on the past year, which was not performing well. But if we look at the companies we invested, the worst performing one had recorded 50% of growth, and the best one had recorded like a dozen times of growth. So this year, we are still positive on the high quality, high tech companies. On the other side, as we are investing in bonds as well, of course, bonds have recorded very good growth from last year. So if you ask me, it's still good opportunity. I would say it's not that good compared with last year, but considering the relaxation of liquidities, considering the risk of these companies, so I think if we want to have a balance between risk and return, it's still a good option. Thank you, Rita. Rita was once overseeing the investment department in long-for properties in China. So I'm sure she has very enlightened perspectives about property market in China. So Mr. Li, also Miss Li, the same question, $1 million question. For me, this year would be a year of fluctuation of assets. If you look at the whole year, there might be not major change in the general trend, but fluctuations will be rapid, so timing is very important. If we look at the period between Christmas last year until now, there has been many changes. In December last year, people were very pessimistic, but now things have turned around in both China and overseas. It's the case for both financial industry and the real economy. And we can look some metrics to see the positive note. For example, VAX was at its low. If we look at other indicators, we can see the positive sentiment. If we look at these PE funds in China, their portfolio, the position has been at the highest peak for the past 2 years. As Mr. Wang said, there were a few reasons. First of all, the change of Fed's attitude. Second, the possible positive outcome of the U.S.-China trade talks. Third, the investors and economists in both China and overseas, they expect a bounce back of China's economy in the second quarter of this year. But these arguments don't hold water, actually, especially the last one. As for the first argument, Fed might stop rate hike and stop reduction of balance sheet at the end of this year. It's probable, but liquidity crunch will still happen. Second, if we look at trade talks between US and China, we can refer to the stories between US and Japan. It was there for 10 years. There would be intermittent tension and then some relaxation, but it would be in twists and turns. As for Q2 situation of the Chinese economy, to me, in Q2 this year, I don't think China's economy will bottom out. It will slide down further. Why is that? The slowdown of China's economy actually started in Q2 last year. But if we look at China's economy in three sectors: consumption, investment, and for investment, there are two parts: manufacturing and then construction industry. The slowdown of China only took place in manufacturing, but not in construction industry. I'm sure, Rita, you know that very well. You worked in Longfor before. Many foreign investors look at Chinese property industry, but the data were not that good. The figures include the land banks, there are self-stated figures. If you look at the driver of a property in China's economy, you should look at the newly constructed area, the newly launched projects. But if you look at these numbers, they were rising last year. At the beginning of this year, they were lower than 10%, but they had been over 20% in the second half. If we look at the sales of real estate, last year it was nearing zero. If we look at source of their financing, it was less than 10%, but the newly constructed area were constantly over 20%. That means in the second half, all the Chinese property developers were trying to battling with the time, trying to sell the property as quickly as possible to collect their cash back. However, the phenomenon in the coming month or in 1 or 2 months will have a fundamental change. Starting from Q3 last year, the land sale in China, the purchase of property developers were slowing down. It was negative at 10 or 20%. So in the midterm, they don't have any intention to increase their inventory. In the recent month, we could see that their financing activities, issuance of bonds, loans, they were also slowing down. That shows that in the coming month, they don't have that need for finance, because for a very long time, they didn't buy any new land pieces. To me, my understanding is that their construction will also slow down. The construction of property developers were at its peak last year, and it was not slowed down in the end of last year. So now we are at the beginning of a new round of slowdown in China's economy, and this trend will probably accelerate in the coming month. So very probably in the second quarter, we will not see the bottoming out of Chinese economy, but further sliding down. Let me give you two other examples. Export was at its peak last year. That was because of the uncertainty of trade talks. Many U.S. companies have increased their stocks. For example, products from China, textile products. If we look at container index of China, in the past half of a year, the shipment cost to U.S. Was rising very fast, but now it's dropping. So this is very clear about export. Third, if we look at the durables in China, they were at its peak in inventory. If we look at automobile, air conditioners, they were at its peak of inventory. For air conditioners, 30% more than last year. Automobile is destocking, but air conditioners have not started yet. This will bring big pressure to China. If we look at these sectors, some some major sectors have the intention to destock. According to the two sessions information, if we look at the newly planned railways, electricity grids, the growth is only 3%. So people have very high expectation for the bounce back of Chinese economy. Maybe you will be disappointed because they will slide down further in the coming year. If we look at liquidity, of course, people hope that the Central Bank of China will relax liquidity. But if you look at monetary increase in M1, M2, they're still decreasing and they're still lower than the rate of GDP growth. We hope that it will happen, but it will not happen. So my view is that in the current period, people are very optimistic of China and other countries. So it might be at the peak for risk weighted assets. I believe for China's stock market, the adjustment will come very early, and the valuation in stock market is still low. Very likely, in the second half of this year, we will have some opportunities in A-share market. And to me, compared with other stock markets, A-share market will bottom out first because of the deleveraging efforts and other reasons, but we cannot be too optimistic now. Thank you, Li Bei, for the wonderful and insightful analysis. So in the third quarter, that will be a very good opportunity to buy in Chinese stock market. And now I think it's a good opportunity to short on the real economy like commodities. But in Q3, you can be long on Chinese A-share. But I cannot give you a specific time. But look at the trends of Chinese economy and wait for the sliding downtrend to end. So, Mr. Wang, what's your view on the bearish view of Miss Li? I believe Miss Li's views are not in contradictory with our views. She mentions the fluctuations of risk assets, so timing is very important. For me, we invested in stocks, not other commodities. For me, what affects stock markets, A-share or H-share market, economic fluctuations, as Ms. Li said, are just one of the reasons. There are other reasons like risk appetites, change of rates, interest rates, and the future changes of policies and US-China trade talks, etc. So if we take into account all these reasons, if we are talking about the future economy, it doesn't make a difference whether it bottom out in second quarter or third quarter. So we don't need to wait for the final jump of the stock market. Probably the final slump of the stock market has already happened. For example, in Q4 last year, there was a big drop in stock market in China. That was because that these investors were revising down their earning forecast. And that was the prediction for the future Q1 and Q2 this year. I mean, these factors were already priced in last year. So with that in mind, we are more looking at the midterm and long-term certainty after short-term uncertainties. So now it's a good time for valuation. Now let's have a polling question. Would you please take out your phone? And the question is,
Class this year, what would it be? 如果你们只能做一种
if you can only bet on one asset class this year, what would it be? I believe most of you will go for equities. 60% go for equities, 12 bonds, and a significant number for cash. So one more question. Talking about real estate sector in China, one question for Rita. Ms. Li talked a lot about Chinese property market and she's very bearish. What's your take? It's very hard to predict. I've been working in this sector for many years, but we try not to make any forecast because Chinese macroeconomy is very hard to predict. It hinges on the central government's policies. Maybe we have different school of thoughts. I'm not a believer of timing. We have a very balanced sheet. So this is to make sure that we are not the last to die. This is our strategy. Of course, this is for operation and management. But speaking of investment, the strategy might be different. As of now, I think the liquidity changes very fast, and the repercussions in real estate market were very clear. Last year, you saw 10% of coupon rate of the bonds in real estate sector, even the double Bs, but now it's 5 or 6%. We don't need money anymore. But last year, many local governments invited the property developers to join the bidding, but they were not daring to go for the biddings because they were probably the only ones to go for the bid. And now, many property developers go for bidding for land, and the premium is very high. That speaks for a very high level of liquidity. If you are investing in bonds, especially high quality ones, the return would be better than last year or the year before last year. But these companies have a much fairer judgment of risks. There's one uncertainty for liquidity, and that is the demand from the market. If you look at the top developers, they're still financially healthy, and they have very good level of construction. In the past few years, the resources concentrated in the top developers with a lot of talents and very high level of developing capability, but we're not sure about the demand from the market. Frankly speaking, Chinese property price has been very aggressively in the past few years. There were uncertainties. That's why many people went for equity in the polling question just now, thinking there might be good opportunities in Asia market. With that, the purchasing power in real estate market will not be as strong as what the government looks for. We have only 1 or 2 minutes left. Just a quick question to all of you. In your sector, what is the biggest risk? Mr. Wang. The biggest risk is, of course, as Ms. Li said, but the biggest risk is not for equity market. I think the biggest risk is the possible outcome of China-US trade talks. We are expecting a successful talk with a far-reaching impact and strengthening the long-term reform of China. However, if the talk doesn't meet people's expectation, it will be a major risk to all the assets. I think the biggest risk is that you pick the wrong management in the in the companies invested. Ms. Li, some foreign banks are again doing some QE, enlarging their balance sheet. So you are talking about upside risk. Thank you for your time. So just to sum up, we have some good ideas for Mr. Wang, A-share market, H-share. For Rita, that is to long on US dollar bonds in China and invest in high-tech companies. For Miss Li, short on commodities, and when there is a sell-off opportunity in Asia market, let's go into the market in Q3 this year.